$50,000 in policy loans just became $50,000 in phantom taxable income, and your insurance agent won't warn you until it's too late. You borrowed against your permanent life insurance to bridge retirement spending or fund early withdrawals. It felt like free money. No application, no credit check, no monthly payment deadline. But here's what the IRS doesn't advertise. If that policy lapses before you pay the loan back, the entire outstanding loan amount becomes ordinary taxable income in that single year. For a retiree who thought they'd have zero taxable income, that's $15,000, $18,700 federal tax bill, plus state tax, plus IRMAA recalculation hitting Medicare premiums by $3,000, $5,000 retroactively. By the end of this video, you'll know exactly how IRC Section 72E transforms your policy loan into phantom income, why your insurance agent's silence on lapse risk is the hidden threat, and what to check in your policy right now if you borrowed more than 5 years ago. Let's start with the wrong belief most people carry into this trap. You think a life insurance policy loan is like a home equity line of credit. If you don't pay it back, the debt dies with the collateral, no tax consequence. That's how mortgages work. The bank forgives the shortfall, but a life insurance policy loan is not a mortgage. Under IRC Section 72E4, a policy loan is classified as an amount received under a life insurance contract. If the policy lapses, that amount becomes taxable ordinary income, not capital gain, not loss carry forward. Ordinary income taxed at your full marginal rate. Here's the concrete harm. Imagine you borrowed $50,000 against your universal life policy in 2019. Your adjusted basis in the policy was $35,000. You thought, if the policy lapses, I lose the death benefit, that's the consequence. Wrong. You owe tax on the full $50,000 loan amount. The IRS doesn't credit you for basis. You can't offset it with the $35,000 basis and report only $15,000 as income. The loan itself, the full $50,000, becomes taxable in the year of lapse. At a 32% combined federal and state rate, that's $16,000 in unexpected tax. Plus, that phantom income pushes you above the IRMAA threshold, adding $3,000, $5,000 in Medicare premium increases retroactively applied. Total cash flow in year of lapse, $11,000, $15,000. Why is lapse risk accelerating right now? Rising interest rates since 2023 have crushed cash value accumulation in universal life and variable universal life policies. Policyholders who took loans 5 to 10 years ago, when interest rates were near zero, now face declining cash values and ballooning cost of insurance charges. The insurance company charges you an internal loan interest rate, often 6-8% in 2024-2025, to carry the loan, and that rate is deducted from your policy's cash value monthly. If the cash value can't cover those charges, the policy enters lapse spiral. Your agent gets silent. By the time you get the notice, you have 30-60 days to either pay up or watch the policy collapse. IRS Publication 590B, page 14, confirms the mechanics. If a life insurance policy lapses with an outstanding loan, the loan amount is treated as having been received under the contract. The basis rules in IRC Section 72B do not protect you here. This is the exact language that creates the phantom income trap. Here are the 3 questions your insurance agent should have answered before you borrowed. First, what's your policy's surrender charge schedule, and how much will it cost to surrender this policy if you want to close it before the maturity date? Surrender charges can be 5-10% of cash value. On a $100,000 policy with a 7% charge, that's $7,000 gone. Second, if you take a loan, what's the internal loan interest rate, and how does it reduce your cash value each month? Most agents gloss over this. A 7% internal rate compounds monthly, eating your cash value faster than you realize. Third, at your current age, how many years until your cost of insurance charges exceed your policy's cash value projection? This is the lapse risk window. If you're 58 and the policy is projected to lapse at 72 and you have a loan outstanding, that's a 14-year sword hanging over your head. Your agent rarely answers these with specifics because it exposes the risk baked into permanent life insurance in a low-interest rate environment. What should you do right now? If you hold a permanent life insurance policy with an outstanding loan, pull your latest policy statement. Check cash value balance, loan balance, cost of insurance charges, usually listed as COI or monthly deduction, and surrender charge. If cash value is trending downward and COI is rising, request a lapse projection from your carrier. They are required to provide this under NAIC model regulations. If lapse is projected within 5 years and you have a loan, consult a tax professional and insurance advisor immediately. You may need to either repay the loan, surrender the policy, triggering gain calculation, but at least known, or restructure the policy. Don't wait for the lapse notice. By then, the phantom income is baked in. The tax code rewards those who study it.